I feel like people feel potentially intimidated coming in to see a financial advisor because they're like, oh, I did this.
One of the things we keep seeing with clients is the moment of surprise where they say, wait, no one told me about this. And lately, the thing they're reacting to is something called Irma. In today's episode, we'll explain Irma, talk about the blind spots of selling property, and why planning isn't just about today's numbers. It's about understanding future consequences too. Hello and welcome to Money on Your Mind from Edelman Financial Engines. I'm Michael Liersch, a behavioral scientist, financial planner, and chief planning officer at EFE. Thanks for joining us for our conversation about how people are feeling about money, what they're wrestling with, and how financial planning can help you straighten things out. Today, you might notice that in addition to a new planning guest, I'm also wearing glasses. I had to get those because I've been doing so much reading lately. And we're also joined here today with Heather Vavra, an EFE financial planner who has been in the planning industry for well over a decade. She comes to us with an expertise in what's called the decedent process. So those are aging human beings who may be passing soon. She has a lot of insight there. So Heather, welcome to Money on Your Mind.
Yay, thank you so much. You look very studious in your classes today, sir.
Oh, I appreciate that, Heather. You and our listeners are the first to see me in these things. So I
great.
hope. Okay, all right. You're giving me that confidence. So
you should wear them all the time. Yeah.
Well, Heather, you get this like great vibe from you. You have great energy, and I know you're from Wisconsin, and you just got a lot of really valuable things to share. But why don't you first tell the audience a little bit about yourself? Because I want them to see that energy. I want them to know why you're so passionate about planning. So share it with us.
Sure, for sure. So I've been in the financial industry for about 14 years now. I actually have a background in mortuary science. So before being a planner, I worked in funeral services. And so a lot of things that I did was I worked with families planning their end of life services. And I really loved getting close with the families and getting the relationships, but it was kind of like a one and done thing, obviously. And so then from there, I did kind of move into what's called a pre-need specialist, where I would meet with families that were proactively planning, their end of life services. And then I'd actually work with terminal families to help them make some difficult decisions and help them make those decisions so that when something would happen, that everything was taken care of and that the family member could be honored in the way that they wanted. And so I would work with them for weeks, getting close with them. And then again, it's a one and done. And so I got into finance because I'm a secret nerd. And I love building long lasting relationships. And I also love complex scenarios and like the little hidden gotchas that a lot of people do not know about when it comes to taxes and selling properties, like you mentioned, and things like that.
Well, Heather, that's really fascinating connection between your background in mortuary sciences, really working with families who are grieving, and then ultimately connecting that to being a financial planner and thinking about all the ways people can, predict, the implications of that moment, as well as really navigate them very proactively. And it sounds like in the moment and reactively. So we're so excited to have you here today. So let's get into what you're hearing about from aging clients or
For
what
sure.
you're hearing about from people who are aging in general.
Yeah, so I feel like the majority of my appointments and clients slash people in general as of lately is people are starting to get older, physically and mentally, and where they are like, you know what, I don't need my second home anymore. I don't want to take care of my rental property anymore, and and things like that. And so when it comes to selling, non-primary residences or selling a depreciated apartment, there's taxes involved. And so a lot of my clients or even what they do is they say, you know what, I can't take care of my big lawn anymore, or I can't do the snow removal. And it's a big decision to think, I might need to move out of my home I've lived in for the last 40 years. And so what my job is to say, well, maybe you don't need to, you can hire the help for that. But then also what my job is to say, okay, if we're going to sell that asset that you've depreciated, or we're going to sell that cabin that's up north, there could be potential tax ramifications, and so we need to plan accordingly, and or at least just educate you on what's to be expected with those hidden gotchas like Irma.
Well, tell us a little bit about some of those tax implications of selling property and ultimately Irma. Can you connect the dots for us on those
A
two
hundred
big?
percent, a
Okay,
hundred percent. So I
great.
was I was thinking before this podcast, every single person that I've talked to that isn't in the industry has never heard of Irma. And it's a big deal. And so what Irma is, it's called an income related monthly adjusted amount. So IRMA is called an income related monthly adjustment amount. Okay.
So
So what that
people looking
means
it up,
is
there's a double A at the end of Irma.
double
It's not
A.
single
Yes.
A. Yes.
Yes. It's a double A. And so what that is when you are 65 and you get on Medicare and you're on Medicare Part B, and some people choose to get Medicare Part D, the government then calls you a beneficiary. Okay. And so how that ratio is they cover 75% of that Medicare Part B for you. That covers the doctors and things. And same thing with the Medicare Part D, that's the drugs. And you have to pay for the 25%. And a lot of times that comes out of your Social Security. And so, what not a lot of people understand is that the Social Security and the government have different tax brackets, that they call it a modified adjusted gross income, that they look at. And if you go even $1 over that limit, then you start getting a surcharge on, yeah, you start getting a surcharge on your Social Security. And so, for example, if somebody is selling a depreciating property or selling that cabin and things like that. So how it works is, what a modified adjusted gross income is, it's your adjusted gross income. So Social Security, pensions, traditional IRA distributions, ordinary dividends, and capital gains. And so, just for quick things,
Dun
what a
dun
capital gain, yeah,
dun.
yeah,
Right?
yeah. So what capital gains are, let's pretend that you bought the cabin for 50,000 and it's worth 150. So there's 100,000 worth of capital gains since it's not your primary residence. So that's going to get tacked on to your adjusted gross income. And so then with the modified adjusted gross income, they add back in tax exempt interest. So if you have municipal bonds and things like that, and so there's a number. Okay. And so for rough numbers, it does change every year. So for 2026, the IRMA numbers, if you file single, it's anything over 109,000, and if you file joint, it's about 218,000. And so that's before any deductions like your standard deduction. Okay, and so when you get over that, they start taking away some of your subsidies that you get, through Medicare. But the gotcha is you don't get that letter for 2 years.
How do you coach clients in that moment? And then how do you help clients maybe get a bit more predictive about these things? Can you share that with us?
For sure, for sure. And so, like you mentioned, people are excited. Okay, I got this lump sum, and so when you do your taxes for that year is when it goes. Say it goes on your 2025 taxes. Okay, and so how that works is, how IRMA looks is they look at your income from 2 years ago. Okay, and so what would happen is, I'm excited. I sold the rental. I have no responsibilities, and all of a sudden, in a year and a half, you're going to get a letter from Social Security saying, hey, your income was kind of high above our thresholds in 25. And so for 2028, we're going to take away some of your Social Security. And so for like a married filing joint, it's on each person. And so you would think, well, if you're filing joint, it would just be like one, but it's for two people. And so it can be as high as $700 a year up to like almost 10,000, depending on where you fall in that bracket. And so people have moved on in 2 years, and all of a sudden they're like, what is this about? And so I've had people come in to see me that they've gotten these letters that I haven't worked with previously, and I explain things to them. Or I have clients that are like, okay, you know what? I think I'm going to sell my cabin. And I said, okay, so let's run some numbers to see, A, how much money do we need to save out of that lump sum to pay for taxes? Should we pay in quarterly? Should we pay in, Q4? And then also let me show you that with this gain, you're going to be above that threshold. And so you're going to end up having Irma in 2 years. And so you're going to forget about it, but I'm going to remind you.
Yeah. So it's a bit of a double whammy, Heather. And so you're trying to help them then plan for, that future bill, if you want to think of it that way.
Yeah.
Okay.
Yeah, and it can be significant because some people, like for example, some of my farmers, they don't have large social securities. They don't, because they've been self-employed, they've been deducting things, and all of a sudden they sell parts of their farm and they may only be getting $400 a month for social security versus other people that have had W-2 income might have 2,000, and all of a sudden they're going to lose half of that because of Irma. Like, that does affect a lot of things.
Well, Heather, I'm really glad you shared with our audience. Can you just share with us, either within this context or another context of aging clients, what's the biggest mistake? Our listeners like hearing this. What's the biggest mistake you see clients making as they age or navigate the aging process?
Yeah, I feel like a lot of people talk to their peers, like during their weekly coffee chat, or, they're sitting around the campfire and they talk to different people. Well, this is what I did. This is what you should do. And people don't understand that everybody has their own tax brackets and it's not always the same, and, just a lot of times people will make an appointment to come and see me and they've already done that transaction. And so then I'm limited on how I could help them. So it's kind of like you make an appointment to go to the dentist because your tooth hurts, but you're going to pull it ahead of time. And then dentist is like, that was just a popcorn hull. Like, we could have really easily fixed that. It's kind of like the same concept of like, I just sold my land. And where we could have maybe structured it out differently, or they have the Irma and they don't mention anything to us, and you can actually file a form. It's called it's SSA. It's a SSA 44, where you can actually appeal it. Okay, and so I've helped probably 5 people that I know get out of the Irma because, for example, I had somebody. Their father put his house into the oldest son's name and said, when I pass away, son, I want you to divvy out all of the assets to your siblings. Okay. And so when you give somebody a property, you're giving them your cost basis, right? And so all of a sudden this son's like, I'm selling this, and he had a $245,000 tax bill that was on just his his returns. And so we were able to, to do that form and explain that, hey, it was my father's wishes. And we sent in the payment checks to them saying, hey, can you please forgive me? It was a one-time thing. And we got that removed. And so there are times when there's divorce, or if you sell a property that you were getting income from, you can actually say, hey, I'm not getting that income anymore. Can you not give me the Irma? And so there are certain caveats where it can be removed.
So I really appreciate you putting it this way, Heather, and sharing these stories, because on the first hand, to your point, and we like to dork out on behavioral finance here a little bit, Heather, right? So this herd following idea, chatting with peers, doing what they say, it's a really big watch item, because to your point, everyone's circumstances are very different, especially when it comes to taxation and ultimately the implications of that, with respect to your income and your financial circumstances, your family circumstances. So there's just so much in that. So following the herd, generally speaking, not a great idea. Seeking out professional guidance, help, really doing the research first. So I love that. The second thing that you've really highlighted through these stories is, even though it might feel like it's too late, do not stick your head in the sand. Go to that professional, share with them what you did, even if you feel like it's a mistake, because Heather, in another behavioral finance sense, people have this thing called regret aversion. They just don't want to feel like they did something wrong. So sometimes it's not like they're hiding something. They just don't want to deal with the thing they did, and they let it ride, and it only gets worse or it becomes unresolvable. So sooner is always better to seek that professional guidance to get that help. Do you agree with both those ideas?
1,000%. 1,000. I feel like people feel potentially intimidated coming in to see a financial advisor because they're like, oh, I did this. I don't want to say wrong. They were just uneducated. So they weren't wrong. They just didn't know that there could have been different ways of doing things, and so it's always good to get a professional opinion on things, because you can really mess up some potential big things.
Once the action is taken, especially something like that, it cannot be unwound in many cases. So if you have any questions, any concerns, it's always good to really do the diligence up front, whether that's with a professional or seeking advice and guidance from someone you trust, and really challenging your own point of view and your perspectives on this. So Heather, really valuable guidance. So what we'd like to do is end the podcast with you sharing with us one action that you feel all our listeners should take, whether they're seeking professional guidance or not. What do you think they should do, especially if they're in this domain of working with someone like in their family who's aging, or they're aging themselves?
Yeah, honestly, I feel like everybody needs to get their estate plan done. Okay, it's not an expensive thing, because you can very easily avoid probate by getting beneficiaries on your properties. Beneficiaries are free at the bank, and so a lot of people just think a will's good enough, and a will is not good enough. You need more, beneficiaries and things like that. And also is talk to somebody about where you are tax bracket wise, because there's potential to be doing Roth 401ks or Roth IRAs, or you might be in a higher tax bracket, but maybe it still makes sense to do the Roth 401 because you're always going to be in that high bracket because of pensions and things like that. And so it's the tax manipulation is where I feel like there's a lot of missed opportunities with some tax arbitrage, if you would.
Well, Heather, thank you so much for your wisdom. It was so great to have you here today.
I appreciated being here. Thank you so much.
So that's everything we have for today. This has been Money on Your Mind. A big thanks to financial planner Heather Vavra for joining me, and we'll be back next Wednesday with a new episode. Subscribe to the show on Spotify, Apple Podcasts, or YouTube so you don't miss it. And we'd appreciate it if you'd leave us a rating too. I'm Michael Liersch with my glasses from Edelman Financial Engines. Talk to you next time.